Have you ever wondered how to build a successful investment portfolio in 2024? In our fast-paced, ever-changing world, investing is not just a luxury, it's a necessity. It's the key that unlocks the door to financial freedom and security, offering us the chance to grow our wealth and secure our futures. But let's not sugarcoat it. Investment is a world filled with potential rewards, and yes, risks too. It's a high-stake game where the stakes are real, and the players are as diverse as the opportunities available. That's why it's crucial to approach this world with a clear strategy. Today, we'll delve into 5 indispensable strategies that can help you navigate this complex landscape effectively. Diversification, regular investments, adopting a long-term perspective, risk assessment, and regular portfolio review. Building a successful investment portfolio might seem daunting, but with the right strategies, it's absolutely achievable. Our first strategy is diversification. But what does that mean? Diversification, in the context of investing, is essentially a risk management strategy. Think of it as a way to spread your investment wealth across a variety of different assets or asset classes. The idea is to mitigate potential losses by ensuring that your investments are not all concentrated in one area. Imagine it this way. You're at a buffet and there are a multitude of dishes to choose from. You could load your plate with only one type of food, but if it turns out to be less appetizing than you expected, there's a good chance you'll leave the buffet unsatisfied. However, if you select a variety of dishes, you're likely to enjoy your meal more, even if 1 or 2 items are not to your taste. This is essentially how diversification works in an investment portfolio. By spreading your investments across different assets like stocks, bonds, real estate, and commodities, you're not relying on the performance of a single asset or market. If one asset doesn't perform well, you have others that may be doing better, balancing out your overall returns. Diversification is vital in minimizing risk because it's nearly impossible to predict with certainty how a particular investment will perform. No matter how much research you do, there are always factors beyond your control that can impact the market. By diversifying, you're not putting all your faith in one investment and hoping for the best. Instead, you're spreading your risk, and that can lead to more stable, consistent returns over time. But here's the catch. Diversification isn't about just randomly picking investments. It's about choosing a mix of assets that align with your financial goals and risk tolerance. A well-diversified portfolio takes into account a variety of factors, including the investor's age, income, financial goals, and risk tolerance. So remember, don't put all your eggs in one basket. Diversify your investments. Moving on to our second strategy, regular investments. This strategy is all about consistency and discipline. It's about investing a fixed amount of money at regular intervals, regardless of the market conditions. This could be weekly, monthly, quarterly, or annually. Let's dive a bit deeper into the concept. Regular investments, also known as dollar-cost averaging, is a strategy employed by many successful investors. It allows you to purchase more shares when prices are low and fewer shares when prices are high. Over time, this can result in paying a lower average cost per share. But what makes this strategy truly powerful is the magic of compounding. Compounding is the process where the returns on your investments begin to earn returns themselves. It's like a snowball rolling down a hill, growing larger and faster with each turn. The longer the time frame, the larger the snowball becomes. Imagine you start investing just $100 per month. It might not seem like much, but over a period of 20 years, even with a modest return rate of 5% per year, you would have accumulated over $40,000. And that's only with $100 per month. Increase the monthly investment or the return rate and the end figure can be significantly larger. Now, this strategy is not about timing the market or picking the next big thing. It's about consistent, disciplined investing, regardless of whether the market is up or down. It's about making investing a habit, a part of your financial routine. And remember, it's never too late to start. It doesn't matter whether you're in your 20s, 30s, 40s, or even 50s. The most important step is to start investing regularly. To sum up, regular investments or dollar-cost averaging is a strategy that can help you build significant wealth over time. It leverages the power of compounding and eliminates the need to time the market. It's a simple, disciplined, and effective approach to investing. Consistency is key. Regular investments, no matter how small, can lead to big returns. Our third strategy is to maintain a long-term perspective. When building a successful investment portfolio, it's crucial to think in terms of decades, not days. That's right, We're talking about long-term investing. With this approach, you're not only giving your money the time to grow, but you're also allowing the magic of compounding to do its work. Now you might ask, why is a long-term perspective important? Well, the answer lies in the nature of the market itself. It's a well-known fact that markets can be unpredictable and volatile in the short term, often influenced by temporary events. But over the long haul, these short-term fluctuations tend to smooth out. Consider this. If you're an investor who panics and sells during a market downturn, you're likely to miss out on the potential recovery and growth that generally follows. By maintaining a long-term perspective, you allow your investments to ride out this volatility, boosting the probability of achieving positive returns. Moreover, long-term investing offers the advantage of compounding. Albert Einstein once famously said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Compounding is the process where the returns on your investment begin to earn returns of their own. Over the long term, this can lead to exponential growth of your investment. There's no denying that this strategy requires patience and discipline. It's not about timing the market, but time in the market. It's about resisting the urge to react to short-term market news, and instead, keeping your eyes on your long-term financial goals. Just remember, every successful investor from Warren Buffett to Charlie Munger advocates for a long-term perspective. They understand that wealth is not built overnight. It's the result of consistent, long-term investing. Patience indeed is a virtue when it comes to investments. So, stay committed to your investment strategy, keep a long-term perspective, and watch your wealth grow. It's all about playing the long game. Scene script. Strategy number 4 is all about risk assessment. Imagine standing on the edge of a cliff, looking at the vast expanse of the ocean. Investing is much like that. It's a leap into the unknown with no guarantees, but the potential for great rewards. The key, however, is understanding how high that cliff is and whether you're equipped to make the jump. Understanding one's risk tolerance is a critical part of this process. It's about knowing how much risk you're willing to take and how much uncertainty you can handle. It's about understanding that not all investments are created equal, and different investments come with different levels of risk. Some investments, like government bonds, are considered low risk because they are backed by the full faith and credit of the government. But the returns on these investments are generally lower. On the other end of the spectrum, you have high-risk investments like stocks and cryptocurrencies. These can offer higher returns, but they also come with a higher level of risk. The value of these investments can fluctuate wildly, and there's a chance you could lose all of your investment. So how do you balance these risks? It's all about diversification, which we discussed in Strategy 1. By spreading your investments across different asset classes, you can reduce the overall risk of your portfolio. If one investment performs poorly, the others might perform well and offset the loss. But remember, all of this comes down to your personal risk tolerance. If you're someone who can't sleep at night knowing your investments might lose value, then perhaps a more conservative approach is best for you. On the other hand, if you're someone who is comfortable taking on more risk for the chance of higher returns, then a more aggressive approach might be suitable. In either case, the important thing is to make informed decisions. Research your investments thoroughly, understand the risks involved, and make sure you're comfortable with the level of risk you're taking on. Knowing your risk tolerance and making informed decisions is crucial to successful investing. Our final strategy is regular portfolio review. A crucial aspect of successful investing is the regular review and adjustment of your portfolio. It's not enough to simply set it and forget it. Instead, it's vital to keep a close eye on your investments, ensuring they continue to align with your financial goals. Market conditions can change rapidly, sometimes in unpredictable ways, which may significantly impact your investments. Perhaps certain sectors are experiencing growth while others are declining. Regular portfolio reviews allow you to adapt to these changes, rebalancing your investments as necessary. In addition to market conditions, personal circumstances can also change. Maybe your risk tolerance has evolved or your financial goals have shifted. Regular portfolio reviews ensure that your investments reflect these changes. Furthermore, as investment goals evolve, it's crucial to reassess your portfolio to ensure it's geared towards achieving these new objectives. Regular reviews ensure your portfolio stays on track. So there you have it, 5 key strategies for successful investing in 2024. We've journeyed together through the landscape of investment strategies, each one a vital piece of the puzzle. Let's take a moment to recap, to ensure these strategies are firmly etched in our minds. Our first strategy was diversification, the art of spreading your investments across various asset classes. Like a well-balanced meal, a diversified portfolio offers a blend of different flavors, each contributing to your overall financial health. Then, we talked about regular investments, the steady rhythmic beat of your investment journey. By consistently contributing to your portfolio, you harness the power of compounding, turning small acorns into towering oaks. Thirdly, we explored the long-term perspective. In the world of investing, patience isn't just a virtue, it's a strategy. The market has its ups and downs, but over time, it's proven to trend upwards. Think of it as a marathon, not a sprint. Our fourth strategy was risk assessment. Understanding your risk tolerance and aligning it with your investment choices is like having a personalized map for your investment journey. It helps you navigate through the rough seas and stormy weather that occasionally darken the investment horizon. Finally, we discussed the importance of regular portfolio reviews. Just as a ship's captain regularly checks his course, so too must you review and adjust your portfolio. This ensures you stay on track, adjusting sails as necessary to catch the prevailing winds of the market. Each of these strategies is powerful on its own, but together they form a comprehensive approach to successful investing. They are the pillars upon which you can build your investment portfolio, a foundation as solid as it is dynamic. So, are you ready to start your investment journey? These strategies are not just theories, they are practical tools, ready to be used. They are your compass and map, guiding you on your path to financial freedom. Remember, the journey of 1,000 miles begins with a single step. Your investment journey begins today.